If you're a business owner, a retail investor, or just someone curious about where money flows when the economy changes, private credit is a big deal. Even if you've never heard of it, private credit has quietly become one of the most important and fastest growing corners of global finance. We're talking trillions of dollars outside the traditional banking system. It's transforming how companies borrow, how investors earn returns, and how financial risk is distributed through the economy. So today on Brain Snacks, we're unpacking private credit, what it is, where it came from, why it exploded, who's behind it, how it compares to banks, and what risks and opportunities lie ahead. Let's rewind for a second. Historically, if a company needed a loan, it went to a bank. For over a century, commercial banks were the main source of credit in the economy. They took deposits, lent money, and made profits on the interest spread. But starting in the 1980s, that began to shift. New financial regulations, rising institutional capital, and growing demand for alternative investments gave rise to shadow banking, a term for non-bank lenders that operate outside traditional deposit-taking institutions. By the early 2000s, hedge funds and private equity firms had started to experiment with direct lending, but it was still a small corner of the market. Then came 2008. When the financial crisis hit, banks were crushed by losses and forced to deleverage. New regulations followed, like Dodd-Frank in the US and Basel III internationally, requiring banks to hold more capital and reduce risk. That left a huge credit gap, and private lenders stepped in to fill it. They could move faster, take more risk, and design custom loans for borrowers who didn't fit neatly into a bank's box, and they didn't have to play by the same rules. Because they weren't banks, they didn't face the same regulatory burdens or capital requirements. Then during COVID, the private credit boom accelerated again. As banks pulled back further and interest rates plummeted, private lenders found themselves in the driver's seat, offering flexible financing at a time when speed and certainty were everything, and the market ballooned. Private credit is now estimated to be a $1.7 to $3 trillion global asset class, depending on how you measure it. That's roughly half the size of the entire U.S. commercial bank loan book, and larger than the U.S. high-yield bond market. In other words, this isn't some niche alternative strategy anymore. It's a major pillar of modern corporate finance. So what exactly is private credit? At its core, private credit is money lent to companies by non-bank lenders, often private equity firms, insurance companies, asset managers, or private credit funds. These loans are negotiated directly, no public markets, no syndicated loan desks. And it comes in a few different flavors, depending on the borrower's size and needs. Most common is direct lending, where a company, often owned by private equity, borrows money directly from a private credit fund instead of a bank. Larger or more complex deals might use a unitranche loan, a single big loan that simplifies what used to be multiple layers of debt. Some companies use mezzanine financing, which is like a mix of debt and equity. It's riskier for the lender, but often used by companies who prefer flexible funding. It's often fixed rate and can include special features like deferred interest. Big investment funds can also borrow using NAV loans, which are backed by the value of the assets they own. And for companies with lots of inventory, equipment, or receivables, asset-based lending is another option where the loan is secured by those physical or financial assets. Many of these loans are floating rate, meaning the interest rate adjusts based on a benchmark called SOFR, or the Secured Overnight Financing Rate. SOFR reflects how much it costs big institutions to borrow money overnight using U.S. government securities as collateral. When short-term interest rates rise, SOFR rises too, and so do borrower payments. Other loans are fixed rate, and some include PIK interest or pay in kind, which means instead of paying interest in cash, the borrower adds it to the loan balance. So the lender gets paid later, but takes on more risk. One big reason private credit is so attractive to borrowers is flexibility. These lenders are often faster, more creative, and more willing to tailor a loan to a company's unique needs, especially in complex or time-sensitive situations. And if a borrower runs into trouble, say they breach a loan covenant, private lenders are usually quicker to respond with a waiver or restructuring. That flexibility can mean the difference between surviving or defaulting. Much of the capital for this market comes from institutional investors, pensions, sovereign wealth funds, insurance companies, looking for yield in a low return world. And the biggest names in the game are exactly who you'd expect: Blackstone, Apollo, Ares, KKR, Blue Owl, and Sixth Street. These are the new lenders of Wall Street, only they don't have branches, tellers, or FDIC insurance. And the deals? They're getting huge. In 2023, Blackstone and Blue Owl teamed up to provide a $4.8 billion private loan to Finastra, a financial software firm, one of the largest private credit deals ever. In another example, Ares led a $2.3 billion loan to support Thoma Bravo's buyout of Coupa Software, while KKR financed a multi-billion-dollar deal for Zendesk. But it's not just the billion-dollar headline deals making waves. Private credit has also surged in the middle market, serving companies that are too big for small business loans, but too small to tap public debt markets. These are often private equity-backed companies borrowing $50 to $500 million to fund acquisitions, growth, or refinancing. It's where much of the action is happening, and where private credit firms are now competing fiercely with regional banks. So how do these deals actually work? Let's say a private equity firm is acquiring a company and needs to finance the deal. Instead of going through a traditional syndicated loan process with a group of banks, they call a private credit firm. That firm offers a unitranche loan, one large loan that replaces what used to be multiple layers of debt. It's simpler, faster, and easier to negotiate. The pricing might look like this: SOFR plus 500 basis points with a 1% upfront fee and a few years of call protection, meaning the borrower pays a penalty if they repay early. There's no need to go on a roadshow or find dozens of investors. The deal can close in weeks. This speed and certainty is a big reason why sponsors, especially in private equity, are leaning into private credit. So what's the catch? Private credit is typically more expensive than bank financing. The interest rates are higher, the fees are higher, and the liquidity is lower, meaning you can't easily sell the loan if something goes wrong. It's also more opaque. These deals are private, they don't trade, there's no daily pricing or public disclosure like there is for bonds or publicly syndicated loans. And while private lenders often include covenants, there's concern that in frothy markets, those protections get watered down. That could leave lenders more exposed in a downturn. Which brings us to the big question: is it risky? Is it systemic? So far, private credit has performed relatively well, but it's important to note that the explosion in this market has happened during a long bull run. Since the great financial crisis, there hasn't been a true credit downturn like 2008. And unlike banks, these lenders aren't subject to strict oversight. There's no federal stress test, no lender of last resort, no deposit insurance. If defaults rise, and some funds face liquidity issues or valuation concerns, it could create ripple effects. That said, many analysts argue that private credit is structurally safer than shadow banking in 2008. For one, the capital is long dated. Most private credit funds have lockup periods or gates that prevent mass withdrawals, and they don't borrow short-term to lend long-term, which is what caused so many problems in 2008. Still, regulation may be coming, and it's worth watching. Regulators are asking basic questions like, how much risk is hiding in these private loan portfolios? Are the loans being properly valued? What happens if too many borrowers default at once? In response, we could see rules that require more transparency, like regular reporting of loan performance and pricing. We might also see limits on fund-level leverage, or even capital buffers for vehicles that offer liquidity to investors like BDCs. And central banks are paying closer attention to interconnectedness, meaning how private credit might ripple through banks, insurers, and other parts of the system. So what should you watch out for next? First, regulation, especially in the US and Europe, as policymakers weigh how to oversee this fast-growing market. Second, competition with banks. As interest rates evolve, will more borrowers return to traditional lenders for cheaper loans? Or will private credit hold its ground thanks to speed and structure? third, continued growth of new products like NAV-based lending and large-cap club deals, where multiple private lenders team up on multi-billion-dollar loans. Private credit may have started as a niche, but today, it's shaping how capital flows through the entire economy. That's all for this episode. Thanks for tuning in to Brain Snacks. Subscribe for more big ideas explained simply.